Welcome to this video. Today I'm going to be doing a stock analysis of Agylsis. If you like this video, please don't forget to leave a like and subscribe. And of course, remember this isn't financial advice, this is purely entertainment and education purposes. Now, what does Agylsis make? They make software for the hospitality sector, which is hospitals, no, not hospitals, hotels and restaurants and so on and so forth. So they make what's called packaged software, as you can see over here, because many hotels have restaurants, and so they make something that incorporates the entirety of what they need. Now, currently it's a quite expensive stock, even though as you can see it currently went down from all the way up here from 142 all the way down to we're currently trading at 98. The PE ratio is still 121 compared to the average sector is at 28.6, so it is a quite an expensive stock at the moment. Now, as you can see right here, we just had this huge increase yesterday, and that was because of this earnings. As you can see here, it was insanely well, up by 88%, which is of course amazing, which is also why the stock jumped. And this might be the path towards the previous heights. As you can see, we sometimes see quite rapid rises in the stock, often on earnings. As you can see, it's a pattern we recognize. We have earnings here, it increases. We have earnings here, it increases. Then we have some outliers like this one right here where it actually fell. But then again, like this one, it also fell on that one. But right after that, it increased. So it's a bit of a volatile stock at the moment. But currently, we did see this slowly bottom formation turning out, and as you can see, and now we are currently trading back up. So technicals on this right now is quite great, as you can see, because ever since about the middle of April or so, let's just see here, yeah, at the start of April actually we've been trading upwards. This was the bottom of 64, so it was, and now we're trading all the way up in 98, so it is up by almost 50%, so that is quite great. Now currently, however, we are trading quite highly up here in the RSI, which should mean you should be a bit worried, because this means it's in a bit of what we call overbought territory, so chances are we might see some sharp drops recently. Now, of course, if you don't know this, if something is in the upper RSI, here it's overbought, as I said. If it's below, that's if it's above 70. If it's below 70 and above 50, it's up here, it's in the upward trending channel, which means the stock is going to increase. If it's below 50 and above 30, as you can see here, that means it's in the lower channel, which means it's trading downwards. And then when it's down here below 30, it's oversold. So sometimes you can get quite a scoop in when it's down here. Sometimes, of course, it's still not quite a bargain yet. As you can see here, it's oversold right here and a huge, actually for quite a while, but then it still continues to trade down here. So it actually was, even if you bought here, you would have lost about 50% of your money. So of course, sometimes it's not a great idea to buy down here. So of course, always be a bit more analytical when making trades, especially when the RSI is very, very volatile, or when it's peaking or having valleys. Now the earnings, as you can see here, they are quite great. As you can see, they're like pearls on a string here. They are simply increasing, increasing, increasing. Even though they actually estimated that Q4 would be worse, it is just in tow with the other quarters, so it's very, very nice, and they are continuing to increase the revenue, so it is quite a nice stock at the moment. Now, however, there is quite a lot of competition in the hospitality business with more and more competitors, and a company like Oracle, a huge software company, is also trying to get into the market, and they are by far Agylsis' biggest competitor, in my opinion at least. So of course, be a bit careful, and especially also because, as I said, the PE value of this is so high. Now they don't pay out any dividends, and as you can see here, the annual earnings, they are just increasing and increasing and increasing. We see the revenue increasing more and more, and we see their net income actually being positive now compared to 2020, where it was negative, and then we see increasing more and more and more. So that is quite great, and they also have very nice recurring revenue. So they have quite what's called a sticky business, which means once you first get Agylsis, you are going to stay with them, because why would you change your software? That makes no sense. Then you have to change all systems and so on and so forth, which has increased 98.7% over the past year of recurring revenues. That is, of course, great. That is the one revenue we want to see grow more than the new sales. Well, we want to see them both grow, but the recurring revenue, we want to see that grow more and more and more, of course, because this means that the more and more customers are staying. Of course, we want new customers, but the more customers stay is actually better, in my opinion, because this is a more solid state of money flow compared to always getting new customers. So it is, of course, bells and whistles, but we need both. But recurring revenue is by far, in my opinion, what is most important in a business like this. Now, seasonals on the stock, as you can see right here, is a relatively old company, but let's just go back to 2010. As you can see, for the past 15 years, As you see, some years we have huge leaps up here, and some years we really don't. Like this year, currently we are down by 23%. Then we have a year like 2010, we're down by 42%, and then some years where we're up by 78, 75, 62, 60. So it is a quite a volatile stock, or a bit of a coin flip stock, one might say. So of course, if you want to buy this stock, more often than not, it's a great stock to own. And given where we're lying currently, maybe it's a good time to buy up now. Of course, I can't say, but it is a quite an expensive stock, and it most often is a quite expensive stock. Now, on the technical to this, as I said, it's a buy for the day, probably shouldn't surprise you, and as well for the month, it is a buy, and that is just, look at this, it is a very nice stock, of course, very nice graph, and we also have a golden cross right here, meaning the short-term momentum is greater than the long-term momentum, and it's just increasing the space between this. So currently it is just a buy, buy, buy. Now the analyst rating on this, as you can see, they are amazing. We have 5 analyst rating with strong buy, and interestingly enough, the lowest one is actually below what we're currently at. So a strong buy thinks the stock should be worth less than it is currently. Now, with that in mind, of course, remember that it did just increase crazily yesterday. So of course, it is maybe that one analyst needs to reiterate his analysis, or maybe he thinks that the stock shouldn't be worth more. But then, of course, it's gonna be changed to a hold and not a strong buy. So of course, but overall, analyst rating quite great. You should be a bit worried, however, when you see analyst rating like this, because sometimes analysts more often than not make buy analysis rather than sell. If you just go and check on many stocks on TradingView or on Yahoo Finance, you're going to see more often than not it's going to be a buy. So analysts are often a bit more positive than negative. So of course also be a bit more worried when they're only strong buy or buy. Now the annual earnings, as you can see, we can only see into 2026 estimate, but they estimate to increase that, and as you can see, that is just in so with all the previous years. So of course, that is amazing. Now, if you like this video, please don't forget to leave a like and subscribe. And of course, if you want me to make analysis on any other companies, please leave them in the comment section below.